What's going on, traders? Welcome to the channel. I'm John. That's Groot. We trade options here. All right, we are talking some big things here. Market crash. Is it coming? Question mark. Well, let's talk about stock market crash 2021. These are some ways to hedge your portfolio. Just some strategies to consider if it is the case. So before we dive into that, I'm gonna give you maybe about 3 of those kind of strategies or things to ponder. If we did them all, it would take forever, probably like 1 or 2 hours. So let's keep it short, let's keep it tidy, let's keep it simple. But to also just give you a slight heads up from the recent video, nothing really changed in the portfolio. I haven't made any new trades, at least in Tastyworks, AMC, none of that stuff, except for Webull. So this one has been pretty quiet as well, just to give you an idea. All it was a really speculative play. JetBlue 32 call strike, December 17th. And right now, literally the only reason, well, 2, I guess, the cost was dirt cheap. I was trying to get it at 7 cents, like $7 a contract. Ended up going up to 9. I guess I should have been more patient because it closed at that. But I digress. I think the second reason to give you that I decided on this is it's just a summer trade play. You know, we're gonna see travel during the summer, and I'm not betting the farm or anything. Just really tiny spec play. Like I think $60 at risk right now. And if JetBlue goes lower, then I'm all about it. I'm all about it. I'll add to that position. Let me show you here. So JBLU. This level right here is kind of key so far. So we'd kind of come down a little bit recently with a slight correction, and now at the 17 level, holding that support level quite well. And just to be fully transparent, also Airbnb, I'm interested in Love, LUV, Southwest Airlines. Yeah, those are some good ones that I'm kind of keeping my eyes on, keeping on the watch list there with that setup. So let's talk frothiness in the market, and just give you a brief rundown. Basically what you see is ebbs and flows in the market, right? Just if you kind of zoom out and just look at it naturally, or if you just drew lines, kind of regression lines and stuff, you just see this up then down, up, down, up, down. Same idea here. It's just now, if you look, we're at like two-ish to 3-ish months of kind of this up without much down movement. And so that's sort of just like the natural feeling of the ebb and flow that I'm going with. And as you tie in here, we go to the VIX. The VIX is like one of the key things that I watch all the time. So basically when the VIX is dropping, the market is getting less, it's moving higher. It's inverse to the market as the whole. As the market drops, or there's like these shocks to the system, you'll see the VIX spike much higher. And basically, go back to the SPY. I'm jumping around everywhere again. What happens when we go back to that ebb and flow kind of theory is big money, big like programs, they'll start to like kind of spread FUD and get the market to have some fear sitting around. So you might take a news article that usually isn't a big deal, and for some reason like the big money sell programs will make it a massive deal and then try and spread it to people and then get that to sell off and stuff. So keep that in mind. That's kind of what you tend to see. And as that sort of action and activity happens, then you'll see some drops in the market, and all it does is it creates better pricing for big money, big quote unquote smart money and stuff like that. So that's really the idea there. Now, here's the question: what can you do when situations like that happen? Well, simplest, easiest thing to do is number one, you can always reduce your exposure, right? Like if you have a position, you feel like all you have to do is ask yourself, hey, if this drops, or hey, if this position lost like 50% of its value, am I okay with that? If the answer is no, it's pretty simple. Then reduce your exposure, get out. Number two, the easiest thing to do beyond that would be puts. You can literally just buy puts outright. So as an example, we're now trading around 420 or so, Elon's favorite number. What you could do is you could buy a put lower at say like 415, 418. And just to show you on that, like say Tastyworks, you just go to SPY. I'm on the VIX right now. Let's go SPY. And if you go trade, then there's a ton of expiration dates, which are great. I'll just go like 8 days out. Let's go the quarterly for whatever reason. And puts are on the right, calls on the left. If I go to the puts, right now we're at 423. Maybe I just want to buy like the 415. I'll just click on the ask right here. and that will get me right there. So what this does is I just bought something outright. Max profit is massive. My max loss is what I pay, which is $86. And boom, I have exposure now. That's like basically having a lottery ticket or a bet to the downside in place. And that's kind of the easiest. And some people don't want to sell their existing positions. That's what you can do there. Now, the next one, and this is a little bit more tougher, more trickier, sometimes can be harder to understand, is actually just trading volatility directly. So I talked to you about the VIX here. Volatility index, this fear gauge can spike up or down based on certain things. Like we had a recent event in 2020. Most people may know about it, crashed the market significantly. And this baby went way higher, which was crazy. All the way from, usually we were averaging about 11 as the level. And this thing went all the way up to like 93 or something, which is crazy. And to give you some context, in 2008, 2009 crash, it went all the way to 100. So it gets pretty spiky when things are awry, and you can tie each of these, it's inverse. So as the market goes higher, it goes a little lower, but as more fear gets injected in the market, you see big spikes, and you can correlate these to when we had some market drops. So same thing, ebbs and flows, but to the reverse side there. So you can trade the VIX directly. Some strategies for people are to like buy calls. You can buy a call debit spread, and then there is something else too called the UVXY. And all this is a 1.5x like highly levered short ETF. So if you think the market's going to drop, you can get pretty crazy with it and buy this bad boy. However, a couple things to note: UVXY is a little bit more advanced. It trades in what is called contango. It is literally dropping. You see how I zoom out, and this is just always dropping in value. It is designed that way, so keep that in mind. You do not want to ever buy this and hold it long term. You will lose all your money. That is it. And when you do a trade like this, these dogs got me distracted. When you do a trade like this and you want to literally just keep it for a couple days maximum, most traders love this for like an intraday type of trading situation, and you can actually trade it very highly levered. That 1.5x is huge, but also on the option side, UVXY, you can just go as crazy as you want to with it. The calls are on the left, puts on the right. You can basically buy a 31 call, and if it goes much higher, if this thing spikes really really big, then I mean, next thing you know, you've doubled your money. But again, it's like a flash in the pan. It's very quick, so you want to be attending that trade and watching it at all times. And for me right now, I've said it a few times on the channel, I usually like to spend kind of minimal time at the computer. I don't want to be babysitting positions, especially stuff that's like stressful, makes it harder to sleep. So generally speaking, if I ever do a trade in this, it's because I see a setup and I'm planning on getting out like same day or in the morning or something like that. So keep that in mind. Those are some of the ways you can trade this stock market crash.